Welcome to FM Radio, your go-to podcast for everything in the world of funds management. Whether you're an experienced advisor, a seasoned investor, or just starting your journey, we're here to help break down the complexities of funds management, all in a way that makes sense. This week, we're looking at AI. Most people are playing with AI and marvelling at what it can do. It can write a synopsis for a novel, create amazing photos, graphics and videos. And it all looks like fun. It is fun, but that's kind of the toy shop for the average Joe online. Underneath all that is a genuine seismic shift in the way that software is being created. The role of the coder is rapidly changing, and it's exciting some coders and terrifying others. Which brings us to the key question. If coders are excited and terrified at the same time, should software companies be excited and a little bit worried too? To answer that question, I've invited Justin Woerner and Gary Merkel into the studio. Justin and Gary are two small-cap portfolio managers who have recently been looking at the AI revolution and its impact on small companies and small-cap investing. Hello, Justin. Hi, Gary. Welcome to the show, and thanks for coming in to share your insights.
Thanks, Peter. Great to be here.
Very happy to be here, Pete.
Look, I'm guessing you've both dabbled in a bit of AI fun with ChatGPT and Copilot on the laptop at home on weekends. What sort of things have you created? A younger, more handsome version of you?
I'd say I've been a pretty strong adopter of AI so far. Instead of searching via Google like I did in the past, now I am querying Gemini or ChatGPT with all sorts of interesting things. One that comes to mind is, Gemini, why am I getting brown patches on my new lawn, and what should I do?
And what does Gemini say? Has Gemini solved the problem for you?
Yeah, Gemini was worried sick.
That's good. I'm very human response.
Yeah. Pointed me in the right direction. It's interesting. Knew what suburb I'm in and what the weather was to be expected over the coming days. So very succinctly told me to go down to Bunnings and collect a few items and then, get cracking to get rid of the lawn grubs that evening.
That's crazy.
Did it work?
Yeah, it did work.
Did work. How about you? Are you playing a bit?
A little bit. Maybe not as much as Gaz, but I do find it really amazing. And I am using it a lot more in place of Google, I think. So I'm not necessarily going to Google anymore. I don't Google things anymore. I go to Perplexity or I go to Chat and I ask it the questions that I'm sort of seeking. And it's really amazing, the answers that you get back. And to be able to respond so quickly with such a concise answer, it's for me anyway, it's really just replacing my search functionality, I think.
Yeah, it's becoming very much a part of our life. I know I've had a play. I even had to ask Copilot to make me look 10 years younger, and I actually nailed it. I think it even made my nose a bit smaller too, so that was a bonus. You can have a lot of fun with AI. Someone described it as it's like milkshakes for the masses. Like it really is quite diversionary, and you can actually go down some rabbit holes and have a lot of fun with it. But I guess you can also lose sight of what it really means for our culture, our way of living and working, and for the companies who are competing in fields where the goalposts seem to be shifting quite often. So for our listeners, I think it'd be good to start with the most basic and perhaps the most important question. Let's define just what is AI?
Yeah. So I guess at the very high level, you really just think about it as sort of the systematic replication of human intelligence. So basically just a system that can replicate human intelligence, human thinking, human decision-making, and then ultimately human action as well.
And I guess I think the thing that feels different is, yes, it is sort of, modelled on the human brain. We talk about neurons, and I guess the people who are working in artificial intelligence are thinking the same way. They really are trying to replicate the way the human brain works, and I guess where they communicate and interpret problems.
Yeah, there's been a lot of developments with neural networks, neural networking, which is the system that they're applying. And a lot of that comes back to the Google team over the past 15 years. There was some interesting work that was done out of the University of Toronto around the 2010 mark. And Google quickly pounced on that and look to bring it in. And then, we've seen a lot of those early AI developers that have really fractured off to become the bigger AI companies now.
It's the language processing that really gets to me. The fact that they can understand what's being asked of them, the way that they can frame an answer, think quite deeply, compare options, and then come back with a solution and communicate to you in a very human way is quite a delight. It's a delight to, I guess, the normal user, but I think when I talk about the coders being terrified, they actually have to be probably more human. I think of coders, not wanting to pick on coders, as being part of that sort of geeky tech world in their own kind of loop of working out problems and working out how I could write code to make things happen. And even they are being moved into an area where they have to learn to articulate exactly what their objectives are, what the parameters are, what I'm really asking for. And you get these conversations now happening that are making people communicate better. But it's phenomenal that layer of understanding these incredible language models are coming to fruition. It's not a science fiction thing anymore. It really is happening, and people are very comfortable talking about their lawn or saying, "Can you make me look younger?" or whatever it is, and they get some terrific results. So enormously powerful. The other thing about AI is we talk about that in general terms, but I guess there are two types of AI in general terms, isn't there? Can you tell me a little bit about, one I guess is more generative, which is what we've been talking about. Create something for me, make a photo.
Yeah, so generative AI is really just producing new content. So whether that's text, an image, a video, and then agentic AI is sort of the next step further. So that's really AI that can not only take the insights from the data, but then go the next step and actually make a decision based on that interpretation and then take action based on that interpretation as well. So that's when we're sort of talking about AI agents. So an AI agent is basically an AI system that you can give parameters to, you can give an objective to, and then it'll go off and do whatever it needs to do to basically meet that objective. So a very simple example might be a support agent. So instead of having, say, an IT help desk and a person sitting at the desk having to receive the ticket that's just come in and then log the ticket, record the ticket, prioritize the ticket, and then follow up on the ticket, you can now get an AI agent which will basically do all of that for you.
I think the whole idea of having an AI agent is really attractive. That feels like that's probably going to lead to the massive breakthrough that everybody wants to happen in terms of productivity. It must be exciting entrepreneurs who say, look, I've only got 20,000 in the bank. I need to start this idea moving and I can't afford to hire anyone except get my wife to work for free, but I'd like to grow this business to a few $1 million in a couple of years. This allows them to have not real people, but agents who are assigned very particular tasks, even checking their own work or checking their own code and solutions and giving you that feedback. Are you thinking that's something we're going to see a lot more in terms of the new breed of entrepreneur?
We've been doing a lot of work to try to understand the bottlenecks and the challenges to deploying a model like that, because that really is quite interesting if you end up with one-person companies that can take on incumbent companies. So in the current format, the generative AI that Justin was talking about before, that's really for the consumer and business to drive productivity for people. Very helpful in getting productivity out of the existing labor force. But the AI agents, that's definitely the area where we're getting very excited about longer term, because you could see pretty dramatic changes to the cost base for businesses. But there are some pretty big bottlenecks to overcome that. And some of the key findings that we've had so far, it seems that data is probably the biggest challenge for most businesses. Your typical business will have a tech stack, which is the lingo for what sort of software are you using to run your business, and there'll tend to be a number of different providers, and they tend to be in different formats. Now, to deploy AI agents on top of that, you need your data standardized, classifiable, so you can really create silos for your agents to operate in. And that's the challenges, because the data structure at the moment is not formatted in a way that is easily used on mass scale to replace many different functions. So we're not there yet, but we think at some point that'll become a lot easier. And all the companies we talk to are doing a lot of work trying to get their data into a format that is agentic ready.
It is really interesting, Pete. We're already seeing a few examples of businesses which are generating very large revenues, like tens of millions, hundreds of millions of dollars, and they are basically two people businesses.
Oh, okay.
Built up using agentic AI systems basically to run the business, but also to create the systems behind it, do all the coding behind it, set up the websites behind it, to establish the customer support behind it. So that is really interesting. And the other thing we're sort of seeing, because we're sort of talking a fair bit about software engineers and we're talking a fair bit about coders and what the future is for a software engineer. And actually in the US at the moment, we're actually seeing job advertisements for software engineers going up. And that's being put down to the fact that there is almost like a mini explosion of very small entrepreneurial businesses starting up, trying to leverage the AI capability that they can. And to do that, they're looking to employ at least one software engineer.
Whereas in the past, I guess some of the big companies of a particular size, you're talking about startups, but I guess even existing businesses that are sort of stuck in that very small size, in the past they're going, we've got Excel. We can't afford to have a tech person. It's just not, the company's just not big enough. But maybe now I can stretch to have one person who really knows what they're doing.
Yeah, which works well for the startups. But maybe as Gary was talking about, some of those sort of incumbent legacy businesses that already have the legacy tech stacks, the legacy data issues.
Yes, it's a transition.
Putting AI over the top of that doesn't work as well.
That's a handbrake for them. And the handbrake hasn't come off yet because they've got to do a lot of work to kind of almost take things apart, put it back together again in a format that allows all these things to flourish. It's interesting we talk about AI, and I feel like it's been the buzzword. Like it was actually Collins Dictionary Word of the Year in 2023. So that's when there must have been peak AI conversations going on. But people have been talking about artificial intelligence for a long time, and we're all very excited now and a little bit kind of on edge about how it's moving, where it's moving, what disruption, what positives. But AI is something that's been talked about for a long time. Back into the 50s and early computers, they were talking about it in those terms.
Yeah, I think humans' fascination with automated machines goes back centuries. The actual term artificial intelligence was first coined in 1955. So it was around 1950 that Turing came up with sort of machine learning, and he was sort of talking about automated machines. 1955 was, I think, the first reference to AI. And then, from there, it's really just been a progression, a development, as sort of data has increased, as compute has increased. We've sort of gone through, I think the first chat box expert system was in the 60s, 70s somewhere. 1990s, we sort of had, continuing development through to the 2000s when that was a real explosion in the compute that was available. And then we saw a real acceleration in sort of AI's capabilities through then, through the 2000s, and we ended up with, things like Apple Siri. Yeah, and even Netflix, which is, I'm watching and it's watching me and it's telling me what I should watch next.
So there's been a lot of change, a lot of, slow change and now in recent times quite rapid change around what AI can do and the positives and the negatives. How generally are investors seeing the impacts and how are we seeing that perhaps play out on large businesses, but also on small companies? You guys are both involved with small caps. What are some of the things that you're aware of?
It's been a pretty wild ride for technology-facing small cap businesses over the past 6 months. There was already a fair bit of pressure on the sector with increasing interest rates domestically, but that's really gone to the next level as a lot of investors have been questioning what does AI mean for certain types of businesses. And one of the things that is very apparent is there is a tremendous amount of deflation within software development. We can see that the software companies that we talk to, we ask them about the productivity they're getting out of their software engineers, and some report up to tenfold. So you just think about that practically. If you can get 10 times the level of productivity from a software engineer, that's set us off on really a pretty extensive research project. So we've been talking to a lot of experts, trying to understand the bottlenecks, the challenges, the opportunities. So we think it's a really exciting time to be looking at small cap technology companies.
So when you're talking about software companies, you're talking very much about I guess Australian software companies, and I guess the tech industry, the tech sector in Australia is very different to what might be happening in the US. Like, it feels to me that as an outsider looking at the Magnificent Seven and the money is flooding in that direction, and it's all blue skies and rainbows. It's a different picture here. Why are the two markets so different when it comes to?
It really comes down to the composition of the businesses that are listed on the two exchanges. So here in Australia, we have a very heavy software-based tech sector. So something like roughly 85% of the tech market cap on the ASX is software related. And if you sort of think about what we were sort of talking about, this development of AI has really led to, I think, a large degree of uncertainty. So investors are very uncertain about the future going forward. And within that uncertainty, I think they've taken a lot of tech businesses and put them into one of two buckets. They've either put them into the at-risk bucket, which is a lot of those software-based businesses, and the moat around those businesses seems to be deteriorating. The ability to replicate them seems to be increasing. And then in the other bucket, the winning bucket, is a lot of those businesses which operate around or provide services with regards to the infrastructure that's sitting behind a lot of this AI development. So whether it be the chips, NVIDIA, whether it be sort of the cloud-based providers or the data providers, so your Meta, Amazon, Google, the big players in the industry. And a lot of those are listed in the US. So if you look at the two different markets, Australia's struggled a lot because we've got a lot of the at-risk software-based businesses and not very many of the chip cloud data providers. In the US, it's really the opposite. So they've got a lot more of those large global infrastructure players. So actually the tech sector in the US has held up relatively well.
So US has done well. Australia has been a little bit punished, or we've just fallen out of favour. The software companies have fallen out of favour over the last, 6 months, 12 months. There's been a little bit of a shift away, and that feeling that the moat's being drained, or the moat's being shrunk a little bit. What are the things that I guess a software company is worried about if they feel that they've got a moat? What are the factors that they see as potentially shrinking that moat for them?
I think it probably stems from just the deflation in the software development. So if there is a strong incentive for your customers to develop internally rather than pay a software vendor, and you can develop cheaply, you've got a bit of a problem there. For simple software solutions where a customer can replicate and improve their bottom line while doing it, there's a big risk that they may sort of look to in-house. So that's probably the first part of it. But like all businesses, not all software businesses are the same. They're all actually very different. And there are a lot of characteristics that we think will hold up pretty well in an AI world. So it doesn't matter how cheap it is to develop the code. There are other attributes that can be defendable.
So you're talking about having some companies have a bit more resilience. Like what are the sort of the things that you would look to say, oh, this is more resilient than company B?
Yeah, we've gone through and created our software checklist and the characteristics that we think are defendable. Yeah, so the first characteristic on that list was software providers that have an embedded system. And a good example of that is one of our portfolio holdings, Megaport. Now, Megaport provides software on top of physical infrastructure. And that's what we mean by an embedded system. Megaport actually spends about $100 million a year leasing dark fiber and having physical equipment in data centers around the world. Now, if we think about it in the context of software development costs declining, that $100 million that Megaport is spending on infrastructure per year is still a tremendous hurdle for a new competitor to come in and try and compete with Megaport. And so for that reason, we feel like they're very durable in an AI world.
Yeah, so that's Megaport's got the mega moat. Is there anyone else in the portfolio that has that sort of characteristic, or some of the other characteristics that we talked about?
I think all of our tech names do. I think that probably is what gives me the most confidence around the businesses that we do own, is that of the 4 sort of resilience factors that we've identified, embeddedness, high stakes outcomes, high levels of complexity within the environment, and then sort of low customer incentive to move away. I think a lot of the businesses that we own, or all the businesses we own, tick those 4 boxes. So whereas we're sort of talking about Megaport being heavily embedded, we could also talk about another business which we own, which is SiteMinder. So SiteMinder provides a software platform to small to medium-sized hoteliers, which allows them to basically list their inventory on all of the OTAs, the online travel agents globally. So, we're sort of talking about, potentially a small operator. They might have 20 rooms. They want to be listed on booking.com. They want to be listed on Expedia. And they can do that instead of having individual accounts with all of the OTAs, and there's about 400 of them globally. They can just have an account with SiteMinder and then get access straight through to all of those OTAs. So that's heavily embedded within that business. It's also a pretty high stakes outcome. So you think about, you sort of got a lot of customer data going through the system. You've got payments potentially going through the system as well. So, there's a lot of security consideration there. The reputation risk is very high as well. So, if you end up double booking your rooms, then that's not good for business as well. And it's pretty complex as well. You're sort of dealing with a lot of OTAs globally. There's a lot of movement in price as well. So the other thing that SiteMinder provides is like a revenue management software. So, you might have an event on. You want to make sure that you're getting the full value for your rooms when that's event on. So you need to be able to manage your pricing. So we think, not only does it tick one of the boxes, but the businesses that we own tick multiple boxes, if not all of the boxes.
Yeah, definitely. And bringing it back to just like another practical example, like Justin was talking about the importance of the output and whether the stakes are high. And there's a lot of small businesses that are managing sensitive data. It's not just the big businesses. Like think about within the finance industry that we're in. For a financial planning business, if they were to develop certain parts of their technology stack internally, they're handling customers' tax file numbers, addresses, information that if it's compromised could be the end of that business. Yes. So it sounds great just spinning up software, using Anthropic with Claude Code, vibe coding as the platform's being called. But there are a lot of unintended consequences. And so for us, we're really thinking about what are the risks for customers and looking to do things differently, and how does that compare actually to the financial outlay? Because sometimes it can be pretty insignificant in the overall operating expense, and the downside is enormous if they get it wrong.
Yeah, and also that speaks to the picture of how straight is this journey going to be? How straight is the path from we're in the point of innovation to acceptance? We're living in an era now where we're saying it's incredible change. We're living through this change, but the path from here to it becoming part of our way of life and fully embraced by everybody, it's not necessarily a straight line. And I wonder whether there's a little bit of deja vu, what we're living through now. Have we seen this happen in the past?
Yeah, we certainly have. We came across a fairly interesting study done back in the 70s by a guy called Woerner. He coined sort of his Amora's law, which was basically that we tend to overestimate technology in the short term and underestimate it in the long term. So you can really sort of see that played out if you sort of think about even the dot-com boom, late 90s, early 2000s, where we are at the moment. So you can sort of extrapolate the Amora law into a sort of a 3-phase cycle. The first phase is hype. where everyone gets really excited by this new technology. It's going to revolutionize the world. It's going to change everything. We get a lot of money invested into the sector. And following hype, we get to a point where we're sort of actually trying to implement this new technology, and we go into a disillusionment and disappointment phase, where we realize, okay, maybe this isn't sort of the magic pill that we thought it was going to be, that actually implementing it is a lot harder than we thought. We sort of go through this period where we're sort of succeeding, failing, struggling to adopt, and that potentially can last for 4 to 5 years. And then finally, the last phase of the cycle is the real benefits. That's when we actually get our handle on how to properly adopt the new technology, to utilize the new technology. That's when we really see the benefits coming through from that technology. And if you sort of think back to the .com boom, then I can remember, like, I started in the industry in the late 90s, and I remember back then there was that big rush around the internet. The internet was going to change the world, it was going to revolutionize everything. You know, we had a lot of businesses where I don't know what they were doing, but they simply added .com to the end of their name. They went up 10x. So there was a lot of hype. That hype was unwound in the early 2000s when we came to realize that it wasn't as easy as we thought. But ultimately, everything that we thought about the internet came true, like that revolutionary new technology that we imagined the internet to be did actually come through. It just sort of came through maybe a decade later than what we were expecting it.
Yeah, so it'd be interesting to see if that parallel plays out now, and there's no reason to believe why it wouldn't. We are in that excited, bubbly, joyous what could be.
Yeah.
But there probably will be a point where people start to go, well, hang on, it's just not quite as easy to bed this thing down.
Yeah, so we are sort of seeing a lot of that at the moment. We're seeing billions of dollars, hundreds of billions of dollars being invested. We're not sure who the winners or the losers ultimately will be. And even just if you think back to that .com boom and sort of adding the .com to the business name, we're actually seeing quite a bit of that at the moment as well. Maybe just to tell a little tiny story. We were recently in Japan with the family, and we're going around. We're trying to find this brand called Allbirds, which was like a eco-friendly sneaker business,
Okay.
right? This was for my wife. So we were trudging around Tokyo. We finally found them. We got a pair. The business at one stage was valued at about $4 billion. So they basically were making wool-based sneakers. That's not the case anymore. They sold the sneaker business for $40 million. But just recently, they've decided, they made a big announcement. They're going into AI. The share price 5x on the day.
Wow.
So we still are seeing some of that, like the end of hype phase, where we're seeing simple things like a business simply announcing that it's changing direction and it's going into AI. And then we're seeing sort of that 5x, 10x uplift.
Which is crazy to me to think that a business can do. Is that like a 180? I don't know what. It's just completely different business to be in.
Yeah, that's right. And there's no product. There's no real foundation to anything yet. But just on the fact that they announced that they're going to move into AI,
and there's a little bit of love around a brand. There's a little bit of connection to a brand, but we're actually going to go and do something completely different. It's like going on, we used to make jeans and now we make pasta. How does that work? But the market is still excited by that. And I guess, we've also seen people maybe get a little bit ahead of themselves. Big announcements about the efficiencies that are coming. We've laid off thousands of people and then not long after, perhaps we've had to rehire some of those people. There's been a little bit of that kind of over acceleration and then pull the handbrake back on and a little bit of stop-start.
Yeah, because we are really determining, or we're finding out, we're discovering AI is not magic, and as we've sort of spoken about, you can't just roll out AI in a very smooth way across most businesses. And there have been some businesses which have gone a bit too hard on AI and then realised that they need to wind it back, that it doesn't work quite as well as what they expected, and they've had to rehire some of that support staff. We're also seeing a lot of businesses, like I think there was a recent report come out of the US where something between 40 to 50% of AI projects or developments didn't actually make it to the implementation phase.
Oh, really?
Because during sort of that testing phase, they realized that there was too many issues with it.
So there's a lot of excitement at the beginning and they can kind of get halfway through the project and then they realize that the parameters would be on them.
Yeah, it's just going to be too costly, too difficult to roll out.
Yeah. Yeah. Look, let's bring that back to a bit closer to home. We don't hold a lot of companies in the portfolio, do we? What percentage of those would be regarded as being tech companies?
It's about 18%, and there's about 5 names at the moment that are within the information technology small cap segment for the portfolio.
And you feel pretty good about that, but I guess you're also being, given what we've been talking about, super vigilant. You've got to watch them like a hawk and see what's going on, or have eyes in the back of your head. There's a lot happening around that space.
Definitely. I think we're pretty comfortable with the checklist that we've developed in giving us confidence that these businesses are durable in a low cost software development environment. But that being said, if we see any real material changes, evidence that they're losing market share, or potentially our investment thesis isn't playing out as expected, we'll be quick to cut.
You're quick to cut back, but also quick to identify prospective companies to bring into the portfolio. You've obviously been active over the last few months. Are there other things you're looking at bringing in or have brought into the portfolio?
Look, it's been a really interesting period from the perspective of finding new investments. So the sell-off that we've seen within the IT segment is part of the story, but probably the bigger part of the story is just the increasing interest rates domestically. So even before the Iran conflict, inflation was too hot here. The economy was overheated, and the interest rate outlook had changed dramatically, which places a lot of pressure on the small cap part of the market, particular sectors. So healthcare, consumer discretionary, IT are 3 that are quite sensitive to that change in outlook. So we were seeing a lot of very cheap quality businesses, as it was before the software sell-off really gathered steam. So a lot of opportunities out there. We have pushed in to find a few different types of exposures. The industrial sector over the past 12 to 18 months, we have increased from 3% up to nearly 20%, which is quite high relative to where it's been over the last 5 years. And we think there's a lot of opportunity across the board, but that's to do a lot with trying to just find some different exposures in different parts of the market, different return profile for the portfolio.
It's interesting you mentioned the conflict in the Middle East. As you said, there were building concerns and there are all sorts of factors that are out there. I guess when the conflict breaks out, that's a trigger to make people act now. But there's a little bit of deja vu there, I guess. If we go back, there was another conflict breaking out in the Ukraine. Talk about parallels. History repeating, or is it rhyming or echoing?
Yeah, doesn't repeat but does rhyme.
Does rhyme, yeah. So are we seeing a bit of that? Does it?
Yeah, we're definitely seeing some rhyming, I think, happening at the moment. So if you sort of think about where we are now and where we were in the first half of 2022, then we think there's a lot of similar things were happening then which are occurring now. So the increase in bond yields, we saw that coming into the start of 2022. We also had the Ukraine war, which started off, I think it was February of 22. And we also had commodities doing really well. So there was sort of those 3 main factors which were sort of weighing on the portfolio in 2022. That was also a period of underperformance for the portfolio. So once again, we're sort of seeing that thematic coming through where increasing interest rates, uncertainty globally around a conflict on the edge of Europe, and then really leading to uncertainty with regards to investor sentiment, sort of a panic almost coming through the market, the selling off of the higher quality names, the higher PE businesses, underperformance by the portfolio. And that's really what we've sort of experienced as well over the last 6 to 9 months. So we sort of see that it's a very similar period. Coming out of the start of 2022, as I mentioned, we had some underperformance. Then there was like a period of sort of stable performance. And then as our businesses continued to do what they said they would do, as they continue to put the runs on the board, generate the earnings growth, investors came back and were forced to really recognize the quality of those businesses. And then we went through an extended period of outperformance relative to the market.
So you'd love to think that history would repeat and that you might see something similar happen. I mean, it's very hard to look in a crystal ball, but if history did rhyme, maybe that the nervous investors, the ones who've been hypersensitive, could come back, as you said, if the companies actually perform and do as they said they were going to do. Potentially, you could see the back half of this year may be quite different to the front half.
Yeah, not 100% sure on the timing, but we're certainly very confident around the businesses that we own in the portfolio, and we're very confident around even the medium-term outlook for the portfolio. I don't think much has changed in the portfolio with regards to the quality of the businesses. Even if you look in that tech sector, we're really confident on the businesses that we own, their level of resilience, their level of ability to be able to continue to deliver on the value proposition. We actually think that AI should be a beneficiary factor for a lot of our businesses, whether that's internally with regards to their financials. We've spoken about software costs and software development costs coming down. So, a lot of our businesses at the moment are spending a fair bit of money developing software. So if that becomes cheaper, then that should hopefully help them expand their margins over time, or at least give them, additional benefit to continue to develop their products. So we continue to see, pretty strong faith in our business's ability to continue to generate earnings growth above GDP levels over the medium term. Really what's happened at the moment is we've just seen the PE multiple, the valuation multiple being compressed. But we think that as time goes by and as investors come back to recognise the quality of the holdings that we have, and as the earnings continue to grow, then that multiple should re-rate and we should continue to see some outperformance.
Let's hope we do see that. It's good to look in the crystal ball and to wonder. As you said, it's very hard to tell about the timing, but it'd be interesting to see if things do move back in that direction. And it's a topic that I love to visit. We should revisit it quite often. It'd be good to talk about this again this year if we get the chance. But for today, thanks for walking us through the world of AI and how it affects decisions for small cap investors in Australia. So good to have you in the studio. So thanks, Justin. Thanks, Gary. We'll talk to you again soon.
Thank you.
Thank you.
That's all for this episode of FM Radio. I hope you can join us again soon as we tune into another aspect of funds management that affects you and your clients. The information provided in this podcast is general in nature. You must consider your own circumstances prior to making any investment. For more information, go to our website or speak to your financial advisor. This podcast has been prepared by Elston Asset Management Proprietary Limited, a corporate authorised representative, CAR 427434, of EP Financial Services Proprietary Limited, AFSL 325252.